Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.
Hello, I'm David Thornton, your host for this week's episode of Friends with Money. The global supply chain is in the grips of crisis. Energy shortages, a lack of shipping containers, and too few semi-conductors, among other things, threaten to derail the global economy and bring about stagflation, the toxic mix of slow growth and high inflation. To find out what the ripple effects could be for Australia, we spoke to Sam Macpherson, Head of Treasury at Earlytrade, Australia's largest working capital marketplace. We discussed what parts of the Australian economy have been most affected and what implications this will have for consumers and businesses. Sam, the global supply chain seems to be in arrest. What's driving the problem, and what impact will it have on prices globally and here in Australia?
Yeah, I think if you've read, just about any sort of mainstream media over the past three to 6 months, there's a good chance, they've covered some of the global supply chain issues that we're experiencing. Some of the headlines have obviously been around global timber shortage. We've had shipping container issues, even fuel and energy crisis in the UK and China. And then over and above that, there's been a longer term issue with some semi-conductor supplies out of Asia as well. This is all combining, with the Suez Canal blockage that we experienced in March and April this year. So we're still trying to recover from that perspective. But if we actually look in isolation, there's really three key reasons that these supply chains are experiencing issues. Firstly, when we look at the lockdowns that we've obviously experienced across the world over the past 12 to 18 months, that's caused factories to either shut down or reduce capacity significantly. Secondly, demand has shifted, away from services and into goods. Obviously, restaurants, cafes, bars, tourism, they weren't really an option. So people have spent, some of that government stimulus has certainly sort of gone towards increasing goods consumption. And the flow-on effect of that has been, one, we've had a shortage of shipping containers and also a mislocation, meaning they weren't where they necessarily needed to be to actually meet the demand for those goods. That's driven, shipping container prices to all-time highs. They've more than doubled this year alone. And unsurprising, that's also taken with it, delivery times have blown out. Order backlogs have gone to new highs as well. I think it's important to look at, that's the global supply chain. As you said, it's the connectivity of multiple supply chains is the reality of it. But if we actually look here onshore in Australia, there was an ABS survey done in April this year, and more than 40% of Australian businesses reported that those supply chain issues are impacting them to a great extent. Obviously certain sectors or certain industries were impacted more than others. Transport services, wholesale trade, some of the utility services. But I think one of the really unfortunate parts is that the small and medium-sized business community has actually been hit the hardest. Taking all this into account, we actually produce a quarterly supply chain scorecard that looks at some of those external factors. Then we also overlay the behaviours of the Earlytrade network, which is more than 70,000 Australian business users. And at the moment, that's flashing essentially bright red, which means very high risk. Fair to say, supply chains have gotten more focus than they probably ever have. But for us, it's really our bread and butter. So it feels like we're kind of in vogue or on trend at the moment, which is an interesting talking point.
So the shipping containers thing is an interesting one. You're saying that there's an aggregate lack of shipping containers, but then also the shipping containers we do have are scattered in places where they're just not getting picked up by the main supply chain routes.
Yeah, absolutely. That's spot on. Absolutely right. I mean, the easier one to understand is obviously the shortage. It makes sense, right? You're shifting your consumption from services into goods. So purely the number of goods being transported is increasing. I guess part of the Amazon effect as well. People obviously ordering online and now coming from all different parts of the world. It's interesting when you actually look at the shipping price sort of config around the world. a lot of those containers or those container ships are actually moving, only half full in some directions, but then on the way back, for example, they might be 3 or 4 times where demand is exceeding supply there.
So obviously, inflation is a lagging indicator. So we just got these the September quarter figures, and it had headline inflation at 3%, and that seems to have been driven mostly by new dwelling prices and fuel. Of course, dwelling prices have been going gangbusters for quite some time, so that seems like it's nothing new. And then there's fuel, but a lot of the other categories seem to be, not so bad. I look at, clothing and footwear, for instance, is negative 3.8%. Do you expect that to jump up now that we've reopened and everyone's hitting the shops?
Yeah, I think the reopening sort of discussion is a really interesting one, and we kind of look at it. We've got sort of previous, backward-looking sort of data as an indicator, but also then taking a view on things like business confidence and consumer confidence, and what are they sort of pointing towards. So, if we roll back, I guess to mid last year when the initial lockdown ended, there was a big bump in GDP as we all essentially got back out there and spent the money that we hadn't been able to spend up until then. And that was, from memory, the savings ratio jumped to about 20%, if not a little bit more. That fell off significantly, as you'd imagine, with that GDP boost. But if we roll forward, I think the broad expectation is for that to be repeated this time around, which, sure, that could well be the case. Certainly the last week, if that's a good, in New South Wales, if that's a good representation of the future, then absolutely those sort of, clothing and retail sectors should rebound. But for me, I think it's just, if you dig beneath the surface, I think it's a little bit more murky in terms of, one, if we look forward now, we're essentially going back into an economy where we do have, we've got Delta in the community, so we're back in this living with COVID sort of scenario. What's the propensity of people to be out there doing what we would see as normal things on an ongoing basis? Secondly, for businesses who, I guess, small and medium size in particular, to the extent they do get hit with COVID cases in their shop or their restaurant or whatever it might be, what does that mean for their productivity? Can they keep operating, or do they have to shut down? And that's obviously going to have a tangible sort of effect going forward. I think the other interesting thing to look at as well is the breakdown of that spending last time around. So we all went out, we bought big items, we bought TVs, laptops, home office equipment, furniture, cars, even if we could get our hands on them. So this time around, they're all goods that obviously have significant sort of life. So we're probably not going right back out there and spending on those sort of goods this time around. If you add on to that, the longer these lockdowns have gone on, I think we've all felt it, that you essentially get into this monotony or this cycle of kind of expecting more lockdowns again. So I think it's built this anxiety within consumers and businesses alike, in terms of what actually happens in the future. Yes, obviously vaccination rates are good, but to the extent something quickly reverses, where are they sitting from a consumption perspective?
How do you see the demand side story playing out? So we've had, lots of helicopter money with COVID relief. We've had, reserve banks around the world with their, pumping money into the economy with QE, and that's all winding down. Do you see consumer demand also winding down with it?
Yeah, I don't know if it's as clear as that. Obviously, we do have, that savings buffer. So I think it's to the tune of sort of 60 billion that we've all got in additional savings now across the board. And as I say, the big question mark for me there is really, if we return to normality very quickly and that money finds its way back through those I would say normal channels almost immediately, then sure, it's a very rosy outlook, absolutely. As I say, in my mind though, there's a real risk that you don't get, you certainly don't get the extent of that drop off in the savings ratio, because people become a bit more cautious and they're looking to say, you know what, I don't know what the unemployment story looks like. I don't know what my outlook looks like for my own state. If we've got state divisions in terms of, are the borders reopening, are they not reopening, those sorts of things. So it's actually quite murky from that perspective. Now, the interesting angle that we kind of look at through our platform is what's happening, I guess, on the business confidence side of things. And to me, they're very closely related. That sort of consumption story feeds into what a business is, one, doing, and two, willing to do in the near future. And based on the usage that we've seen, so the usage of our platform, we actually view as a very good leading indicator for business confidence, particularly on the downside. When businesses are less confident, they tend to come onto the platform, look at what cash they can get their hands on, and essentially bring those early payments into the door to give them a bit of certainty for the next few months or even weeks in some circumstances. So yeah, we've seen those big increases in platform usage through the Earlytrade network. March last year, July also when we went into lockdown again this year, and then in September actually we saw an interesting spike. So for me, it's kind of pointing towards perhaps for this coming quarter, it is a bit of an unknown from a business confidence perspective. And then you can get into, how does that flow through into all your other macro variables as well in the economy?
You mentioned before that the outlook is very murky, and we talk about the global supply chain as if it's one thing, but of course it's many supply chains put together. Do you see this cost pressure across the board moving up in lockstep with one another, or will there be some areas that are significantly more under pressure than others?
Yeah, good question. I think it unfortunately it won't be as coordinated as a lockstep sort of movement, and you can see that if you look across some of those issues that we touched on at the start. To me, that a lot of the time they're kind of these pandemic sort of pressures that we've seen through the supply chains, they're actually compounding broader secular sort of changes that are occurring in those supply chains as well. So up into Asia, for example, there's a lot of porting issues where they don't have adequate sort of infrastructure in place, and they're sort of working to get that done. But it's been an ongoing journey, let's say. In the UK, you've got essentially absolutely no foreplanning in terms of what post-Brexit life looks like. So obviously we've seen over there a lack of lorry drivers for obviously the freight sort of community. So these sorts of issues, they're popping up, within industry-specific areas and geographic locations as well. So I think, very, very important to look through the supply chains that you're looking at. Perhaps the companies that you're analysing to say, well, do these supply chain pressures actually create issues for my business in terms of the end product for their consumer or their user?
How much of a problem has Brexit been in terms of supply chains and inflationary pressures? Were the prophets of doom correct in their forecasts when before Brexit took place, or has it not been as bad as everyone thinks?
I think it's still. I think we're only just getting started on that journey, unfortunately. I think with such a quantum shift, to borders as the most simplistic sort of view, right? You're seeing the wage pressures coming through into the UK, and we've got some of them here in Australia as well. Very good example of when you do have a constrained supply of employees. To take a simple view, you do start to get those areas where there's significant shortages, and that's what ends up driving your wage price or your wage cost inflation as well. So yes, I don't know if the doomsayers have been entirely correct, but unfortunately, I'm probably erring on their side more than the other side of that sort of equation.
Moving to the RBA, what do you see the cash rate doing? The 3% CPI figure puts inflation at the top of its 2 to 3% target range. Do you see the RBA lifting rates sooner than the 2024 guidance, I think it was, that they've been running with?
Yeah, so 2024, that's exactly right. I think they've been guiding that for a little while now. I think it's an interesting time. We've essentially got a bond market that's going against the central bank now. So very interesting as to what happens over the next few months. From a tapering perspective, if we look at that before we go down a rate hike sort of movement, I think it's fair to say that if we get a number like the latest inflation print, if we get that for a couple of periods in a row, there's definitely going to be a lot of pressure on the RBA to bring that commitment forward. Where do I sit? I would say, yes, it's definitely an upwards movement. Obviously, it's not 2024, but likewise, it's probably not, in the next 3 months, I would say. So maybe, mid next year, I think is when you can start to see an official sort of tightening of monetary policy. Now, interestingly, I think before then, I think it's already starting to flow through, some out of cycle rate hikes from some of the banks into the mortgage space already. So probably, fair argument if you can still lock in for 2 or 3 years, it might not be a bad thing to look at on your own sort of book. But yeah, it's definitely an upward movement. Probably mid to back end of next year is where I sit on that one.
Guy DeBell said that a little bit of inflation is a good thing. Do you think that's what he really believes in the current context of things, or is that a bit of water on the markets on his behalf?
A combination of both. I think longer term, he definitely sits in the first camp. There's no doubt that I guess you can have good inflation and bad inflation, right? If good inflation is coming from a good place in terms of being demand driven, and you kind of wages are moving up in step with that, then it kind of makes sense. But I think, again, as we've seen through the Earlytrade platform, we're starting to see those pressures build up on the supply chain that won't just be for the next 3 months, for example. There's shifts that are occurring that will be longer or impacting over a longer period than that. And I think the risk there is that you end up with a demand story, as I said at the start, that's maybe not as rosy as you would like it to be, but also these inflation pressures that are lingering for a while. And that's what I would view as bad inflation, and it potentially puts at risk what's happening on the monetary policy side of things. Are you actually tightening to quell those inflation pressures, but at the same time you're dampening the demand story as well, which don't want to get into the depths of stagflation too much, but I think it does create a kind of period of stagflationary pressure. Again, could be 3 months, 6 months, 12 months, that sort of time horizon.
What impact will America's big infrastructure spend, when and if it happens, have on inflation? On the one hand, investment itself is kind of an inflationary thing, but on the other hand, infrastructure spending, you'd imagine, would help alleviate some of these supply side issues.
Yeah, again, I think it comes back to the question you asked at the start. There's going to be certain sectors within construction, for example, that are going to be impacted by a shortage of resources. So the timber example was an easy one. We've gone through this year a global shortage of timber supplies, which obviously put flow and effect into those supply chains, putting additional pressure, and again driving those prices higher. So I think from that perspective, again, important to look at what particular investment are you looking at, what sort of project are you as a company or as an investor looking at, and what sort of risks can you actually identify within those particular supply chains as well. But yes, no doubt that spending story, again, it will create some inflationary pressures just purely from an activity perspective. To me, that's more of a good inflation story. You're bringing obviously huge amounts of investment. With that, you'd hope the unemployment story picks up. Obviously, it's again been potentially not so great over there over the last few months. Probably not as good as we'd like anyway. So I think yes, it's going to create a lot of opportunities from an employment perspective, and likewise there'll be ripple effects through into the Australian economy as well. I've no doubt.
I know forecasts can be a mug's game, but give it a crack. Even the transitory inflation camp, or is inflation here to stay?
I've always been a lower for longer sort of mentality. I think there are bigger demographic sort of considerations from an inflation perspective, from a rates perspective. So I don't think they've necessarily changed. Things like an aging population, changes in productivity, technology, those sorts of things are here to stay. I think, as I say, the risk for me at the moment is really, you've got a period of, I would say, up to 12 months, maybe even slightly longer, where these supply chain pressures are going to continue to exist. When you combine that on the other side with a demand story that's not, it's certainly not where we would want it to be from a business certainty and from a consumer confidence perspective, I think that's what creates the real risk. So it's probably not a shift in the underlying mentality. I think we're not going back to significantly higher rates anytime soon, but obviously it's all relative. A 25 basis point move at the moment certainly looks fairly significant. But if we look longer term, what does that actually look like from an all-in borrowing cost perspective? I think it's still going to be pretty cheap for the foreseeable.
Sam, this has been great. Thanks so much for joining us on Friends with Money.
Thanks, mate.
That was Sam Macpherson, Head of Treasury at Earlytrade. For more content like this, go to moneymag.com.au and be sure to sign up to Friends with Money wherever you get your podcasts.
Thanks for listening to the Friends with Money podcast. For credible, independent and easy to understand financial commentary, visit moneymag.com.au.